So we have chosen not to risk losing FHA ability. FHA still, much like VA, has flexible guidelines. VA is a little easier. FHA requires a little more nuances on debt to income ratio. They really don't want somebody to be overextended on their house payment. So they require that ratio, so that debt to income ratio of just the house, to be lower. They really want it to be below about 36%. So sometimes I've got people who may qualify for an FHA loan, like they have absolutely no debt, they've got good credit, but the house would be like 42% of their income. FHA doesn't always approve that. VA does. FHA doesn't. FHA really cares that you're not house poor. MIP and upfront MIP. FHA is unique in the fact that they charge a 1.75%, much like the VA funding fee, right? So they allow you to add that back into the loan. But they also charge a monthly mortgage insurance premium. These are government-based. They're not private companies. So it's called mortgage insurance premium, not to be confused with PMI, which is private mortgage insurance. We'll talk about that one in a minute. But minimum property requirements, FHA is still a little stricter than conventional, but it's basically just like VA. There's not a lot of difference. Eligibility, you don't have to be a first-time home buyer for VA or for FHA. I hear this all the time. You have to be a first-time home buyer for FHA. No, FHA is not a first-time home buyer program. FHA stands for Federal Housing Administration, not first home. You have to own or occupy an FHA loan. There's no way around this. There's no alternate occupancy. There's no, you can't buy it as investment property. You can, if you buy a home FHA or VA for that matter, and you want to turn it into a rental property later, you can. You have to live in it for at least a year before you transfer it to rental property. You don't have to refinance out of an FHA or a VA loan if you do that. So occupancy, yeah, there we got it. Now, one thing I want to mention on this, these, the state down payment assistance programs work very well with all of these programs. They work very well with FHA and VA. They don't work as pretty with conventional, but they work very well with FHA and VA. There we go. Now we're on conventional. Yay! Okay, these are known as Fannie Mae, Freddie Mac. Has anybody ever heard that term, Fannie Mae, Freddie Mac? Yeah, it is. So Fannie Mae, Freddie Mac, after 2008 crash, went into receivership with the government. So even though they're not considered government-insured loans, they're still government loans. They're not considered government loans. They're still insured by the federal government because they're in receivership with the government. So conventional loans typically require a higher credit score. There's no way around that. They just require a higher credit score. Most lenders will go down to 620, but once you start getting to the lower credit scores, the interest rate shoots way up, the closing costs shoot way up, the mortgage insurance shoots way up. I have had people that we will put into an FHA loan because it's a better loan for them, even though they're paying 20% down. It just depends on the circumstances. Conventional also requires that you have longer between the borrower and some kind of credit event. So if they had bankruptcy, a foreclosure, a repossession, not really repossession, but bankruptcy and foreclosure, deed in lieu, something like that, they're going to require a longer period between that happening than FHA or VA will. FHA and VA sometimes are just 2 years. Conventional is like 6. That makes a big difference. So if somebody's had a bankruptcy and maybe it's 3 years old, I may tell them go ahead and do a FHA loan because it's better for them than a conventional loan, even though they're putting money down. One reason I give you guys all this information is you're spending a lot more time with this borrower than I am. You're walking through houses with them. They're saying things in front of you. If you hear them say something, your first thing needs to be what? Did you let your lender know? And then you call the lender and you go, hey, I just told her I'm talking about my new car. Or mom and dad are going to give them $100,000 for this home purchase, and it's cash. Things like that. There's a reason we give you this information because we're all in this together and you're our allies. Here's the thing. Conventional on down payment. You can put anywhere from 3% down to 80% down. The more they put down, typically the better their interest rate is. Once they put 20% down, there's no PMI. Now remember, I told you there's a difference between MIP and PMI. Okay, PMI is on conventional loans, and it is done by private companies. So they're a completely different company, kind of like another insurance company. They all have pretty much the same guidelines with different nuances. When I'm pricing that for somebody, I'm going to pick the one that has the best price, but also has the easiest guidelines. So some of them say you can't go above this on debt to income ratio. Some of them are like, oh, whatever you can get approved. So we look at that to make sure that we're getting them the right one. And there are ways they can do this PMI. It doesn't have to be monthly. They can pay it all up front in one lump sum. It depends on what they want and what works best for them. So remember when I told you I do that whole strategy thing? This is part of that whole strategy thing for me. Now, understand on occupancy, you can do these as non-owner occupied. You can do owner occupied. Doesn't matter to me. If it's not owner occupied, it's going to require more down. If it's not owner occupied, they're not going to be able to get PMI usually. So I told you I was at an open house the other day. A gentleman came into the open house and he says, oh, I'm so-and-so. And I said, oh, I'm a lender. And the agent said, oh, I'm a renter. And he said, oh, I'm a lender. And unlike her, I can do more. I was like, oh, this is going to get good. He started telling me about the 10% down investment. I said, that's great. Who do you use for PMI? He sat there for a minute and goes, well, I mean, you know, I'd have to look into that. Okay, don't advertise something that you don't know about. And then he started talking about another program that got yanked on Friday. Company quit doing it altogether. I said, so did you have any loans that were affected by them not funding those loans on Friday? I'm going to have to look into that. All right, there are lots of programs out there that sound really too good to be true, right? Yes. Those non-QM programs, we're seeing those being yanked left and right because they're riskier. And those companies are trying to manage their risk and pull some of those programs. So yes, I have access to them. Yes, I've closed a few of them. But when I started seeing the reps saying, it may not be here tomorrow. I was like, well, let's not market that one anymore. There's a lot of programs out there that you really have to be careful because they do come and go. All right, USDA, let's talk about this one. USDA. Minimum credit score right now on USDA, put out by USDA, is 620. They also have an upfront mortgage insurance premium. So they have mortgage insurance premium structured like FHA. They have an upfront mortgage insurance premium, and then they have a guarantee fee that you pay monthly. This changes every year depending on what their funding looks like. USDA does not require a down payment, so it's a zero down. But what you have to remember about USDA is there's income eligibility and location eligibility. And this is the big one. We used to have tons and tons of USDA eligible properties in Bell County and Cornwall County. Those have really shrunk down. It used to be all of Nolanville was eligible. Most of Parker Heights was eligible. A lot of Colleen was eligible. We don't have that anymore. USDA came in and said, yeah, no. It's meant for rural properties. I'm not talking like farms and ranches. I'm talking like somebody sitting out there on an acre. It's meant for that kind of a buyer. It is required to be owner occupied. But remember, it has that income limit. So in our area, the income limit is $130,000. That's a pretty good number. It used to be like 65. So they've come up, they're catching up, but you do have to check that eligibility. I could send you the website, but even easier would be to Google USDA property eligibility. They'll take you right to their site. And then you can type in an address and you can see if that property is eligible. I see a lot of properties on the MLS that say they're eligible for USDA, but they're not. So you really have to independently verify that if that's important to somebody in your.
Is that something that we do or something that the system does itself?
No, you have to do it. You have to do it. As far as I know, I don't have access to MLS, but I do see USDA being an option. Sometimes I'll see USDA being an option, but not VA. And I'm like, the USDA does require the house to be in decent shape too.
What was the percentage on the upfront, the down payment?
Down payment is 0.
I mean, not the down
The
payment.
guarantee fee right now on USDA is 1%, and that gets rolled into a loan unless they want to pay it themselves.
And that's not,
No, that's
One
one
monthly.
time, and then monthly is 0.35 annual fee. So it's still less than FHA, but understand it's really restricted in the areas. I haven't. What?
What did you say about 3.5%?
point.
0.35. That's it's called the annual guarantee fee, and it's paid monthly.
For the rest of the
And FHA, remember, mortgage insurance on FHA is for the life of the loan now.
And what was the upfront, primary, is that, is it a premium?
On
upfront?
USDA,
Mhm.
1%. But they can roll it into their loan. It's kind of like VA that way. But it does have that monthly guarantee fee. It's
Are there
annual
interest
fee
rates
monthly.
for USDA lower?
They're about the same. They're about the same. It depends on the day, but they're about the same. I'll be honest with you guys, I've done maybe one USDA loan a year for the last 5 years. They're not a big portion of our area because a lot of the people that are buying out those properties have VA, which is a better vehicle for that. And it's tough to find a property that's USDA eligible right now. We just don't have a lot of them there. We're too populated. Gerald used to be all USDA. I don't think there's anything in Gerald that's USDA.
Code was USDA.
Mm-hmm.
Part of it is not any longer anymore.
Yeah,
I think that's right.
a little bit. Outside. I mean, not inside San Antonio, but outside San Antonio. Yeah. So, any questions about USDA, conventional, FHA, VA?
So how was it again, to say that you have to roll it, like you'll pay a 5% and it brings down, the payment by
Funding.
half, the funding fee by half?
Yeah. Sometimes a little more than half. I'd have to look at the chart today, but so I think 10% brings down the funding fee to 1.5. I think 5% brings it down to 1.65. Don't quote me on those numbers, but it's pretty close.
Question.
Mhm.
You said your company doesn't charge the lender fee.
On VA. Mm-hmm. We waive our lender fee with VA.
And it doesn't matter if you have disability or not?
No, because that's not the funding fee. The funding fee that's charged by VA, and they'll waive the funding fee no matter what percentage of disability you receive. The lender fee is what the lender makes, so that's our origination fee. So origination fee, sometimes you'll see them as processing, underwriting, application. We waive
Especially
those.
when they end up paying
That's part of their closing costs.
when they can see the payment.
Yes, it is. But that just means that when we do a VA loan, it's a little less expensive than other companies do.
Now, VA funding fee doesn't, it can't be access to VA.
VA funding fee, you do pay a VA funding fee if you're active duty. If you are receiving disability, VA will waive that funding fee.
While you active duty.
It's hard to get
Yeah, you can't
disability and be active. Yeah. I have one right now that is actually receiving disability and is active duty. But that goes back to some other things.
Yeah,
They're
it
very
gets kind of like
rare.
messy.
It's extremely
Rare.
rare.
Yes.
It's extremely rare.
I have seen 2 cases this year, which is very rare. I never seen it.
I hadn't seen one in 5 or 10 years, and then this guy came in my office and he's like, nobody understands. I was like, actually, I do. But you're a unicorn, so. Yeah.
You have to figure it out.
I don't know what the disability is. He was active duty. He went into the reserves. He got disability when he was in the reserves, and then he reactivated.
Yeah.
So he's actually receiving like 80% disability. I didn't know you could get reactivated if you were receiving disability.
Disability.
Yeah.
Interesting.
So it was interesting, and literally that's kind of a unicorn. You don't see that very often. I'm sure he did, but, it's unusual to see, so typically if they're active duty.
to get them, or easier, and then we'll.
Cheaper.
It's gonna be less expensive for them because they qualify to waive the frontage fee. Getting an underwriter to wrap their head around that is.
That's the
pretty
creative
amazing.
It's gonna take a little bit of time.
It
It's a
usually-
project.
So if you run into, like, if I run into a buyer like that, I just have to make the contract long enough for the underwriter to
Yeah.
talk with them.
I'm talking underwriting and things pretty quickly. It doesn't take that long. Yeah. I mean, when they have super unique situations, I typically recommend you do 30 days anyway. That gives everybody time to get through that unique situation. This guy in particular, we've already got him through underwriting before he even got under contract in the house, because I wanted to make sure we didn't have drama. But again, that's gonna be one of the reasons that I recommend you work with a local lender that you can see, touch, talk to. Because when they go to some of those big banks where it's a call center, they often don't start collecting documents and underwriting or reviewing documents until they have a contract in hand and they're like 5 days completed. I hate to see that because I've seen it a whole bunch of times. But working with somebody that's boots on the ground is way better than working with somebody in a call center.
That just happened to one of the agents, I would say, in Austin. Oliver had a client, and they did it for qualification. And I told him, I said, I know it's a new bill, and they want to pay and everything, but just so you understand the qualification, sometimes the lenders do qualification without documentation, just going by what the client says. Well, the client says that he had a job and he was there for a year already, and he was in permanent status. Well, when it was about to close, they called and verified, and it turned to say that he's 1 year in the job, but he's a temp. He's not a permanent worker there. So that just didn't work out. It just killed the deal.
So that would go back to your ASU, how you say the?
AUS? No, that's not even AUS. That's
The acronym?
eyeballs.
Yeah,
No,
Oh,
it's
yeah,
called
yeah, garbage in, garbage out.
that cannot be done even manually.
No, I mean, last month I had somebody who told me that he worked for a company. The company's initials were the same as his initials. And I
I can see
said,
that though. I can see that a lot of people will do that to like TikTok or Instagram or whatever.
and he's W-2 with this company.
Yeah.
Okay, do you own the company?
Yes.
No, it's an LLC.
Yeah.
Who is the owner of the LLC? The LLC.
No.
But who are the principals in the LLC? Well, I mean, I'm not sure.
Who signed the paperwork?
So we went to the Secretary of State's website and showed up at 10 and called them and I was like, look, we know it's you. Well, but I'm not self-employed. If you're the owner of the business, you are considered self-employed. Nope. I saw it and I went to the seminar where they told me and all I just said my LLC, I'm W-2, you have to treat me that way. He only had a business open 6 months.
Wow. You can't do nothing.
Moral to the story, if you're gonna try and do all that and slide it under the rug, don't name it after yourself. At the end of the day, we would have found it anyway. But it's all in how we underwrite. I just did a loan for a partner of a big CPA firm. I guess it's not big 8 anymore, it's like big 3 CPA firm in Houston. And I'm talking to him about it. I'm like, look, imagine underwriters as IRS auditors. Their whole function is to find something they can ask a question about. The minute I compared it to an IRS auditor, he's like, oh yeah, no problem. Get you that paperwork right away. It's speaking their language. He understood it as IRS auditor. Oh, yeah, no problem. We just do what we can with them and get them out of our office. Okay, let's just get the answer what they asked for. We get our closing and we move on. That's why we do all this. Is it not true?
Yeah, you do.
Okay, so we're ready for our next slide. Now let's talk about non-QM. So back in '08, when the market crashed, was anybody in business then? Anybody in business then?
I was probably.
When the market crashed in like '08? You
Oh,
were?
yeah.
Okay, so back then we did all kinds of loans. You didn't even have to prove that you were employed. We could do a no-doc loan with 5% down. I mean, all you had to do was fall the mirror. That was the government said everybody deserves a house. And so everybody got a house. I had people coming in from California that were going to do a food truck, and they claimed they were going to make $10,000 to $15,000 a month. Then you need to have a fleet of food trucks. But I wasn't allowed to say, yeah, that doesn't sound plausible, because then that got discriminatory, because I was discriminating against someone. I wasn't, but it didn't sound plausible. The hairdresser would come in and tell me that she was going to make $15,000 a month.
Nowadays, back then, no.
Even now, because it got business. So, I mean, there were loans like that. So the government came out and said, you know what? Unless you do a qualified mortgage, we will not insure that mortgage. So qualified mortgage means that it has to go through the AUS. Non-QM loans do not go through AUS. Non-QM stands for non-qualified mortgage, sorry. So non-QM has become this really up-and-coming thing. It used to be known as hard money. But now we have these programs that are actually non-QM. So debt service coverage ratio. That's how people buy investment property without having income to show it.
How do you say the name?
DSCR, debt service coverage ratio. That means that the rent is going to exceed your payment. And so we can use that to qualify you for these investment properties. That's great, especially for people who are self-employed or people who are building their investment portfolio. They do require more down. They can't be owner occupied because you won't have rent if you're doing a debt service, they're living in it. There are lots of these programs. Now remember, I told you about this guy coming in the open house this weekend and talking about this mortgage that I watched implode on Friday. The company actually, they had funding sitting out there. They had people who closed. All they were waiting for was the money to get there, so the house to be theirs. And this company came back and said, nope, we're not funding any of these. The risk is too high. We're done. I remember that happening in LA when Countrywide imploded. It happened. We had loans out there that could not be funded because Countrywide went out of business in a moment.
Oh, what year was that? I forgot.
That's like
Imagine
97
you waiting for it to move in your house and they say, no, you don't have it. Whoa.
I remember.
Yeah, I remember those. Those were the subprime mortgages, and they just went belly up overnight. The entire market kind of imploded on that. That's why we have these QM mortgages now. If it's not QM, then it's not insured by the government. Because remember, USDA, VA, FHA, Fannie Mae, Freddie Mac are all insured by the government. So non-QM mortgages aren't. Interest rates are going to be much higher on non-QM mortgages. I expect to see some of the non-QM programs go away. We've already seen, I think, 4 companies shut their doors. One of them was instructed by the government to shut down yesterday.
Oh, wow. They're not getting payments?
So the story that came out yesterday is this company had a whistleblower come out from the company that said they were actually discriminating against minorities in some of their programs. I haven't had a chance to read the entire article, but they shut them down in a heartbeat. It happens.
But you said they're not guaranteed.
They're not guaranteed. They're not, these are private companies that are then probably holding them too. So they're servicing it themselves. Non-QM, I think we'll see the continuance of non-QM. I think we're going to see it get a little stricter because, face it, like it or not, we're headed toward a recession, right? It's just part of it. When we have a contracting of the economy, credit guidelines and credit standards get stricter. I am already having people call me and tell me that their credit card company reduced their credit card limit.
Oh yeah, I have 3 of them that use my credit limit.
Credit card companies are reducing that credit limit because they're seeing the writing on the wall. Those are the first ones to do it. Mortgages will come next.
What they gonna do with the money?
They're gonna increase the credit standards.
So you're gonna get
Oh,
a
okay.
to qualify.
Yeah,
I thought you were talking about the folks that already got.
no, you can't,
I was like, what you better do?
no, you can't reduce their limit then, but we're seeing credit card limits decrease. One of my clients told me the other day, she had $22,000 limit on her credit card,
So that is like
$2,000 balance. They reduced her limit to $5,000. So suddenly she's got a 40% utilization and her credit score dropped too.
That's what happens to me.
But that's the first sign. Oh, I'm sorry, we've had a lot of signs. This is the first, like, where real people are seeing it. Because that's their job. Their job is to mitigate risk. Chase, Citi, all the people that issue credit cards, their job is to mitigate risk. They want to make sure they're not losing money. So let's go to the next slide. Now we're going to talk a little bit about down payment assistance. Down payment assistance is our state programs. You've heard of TDHCA and TSAHC, TSHAC. Those are the down payment assistance programs. Somebody called me yesterday and told me that her realtor told her that she should ask me about down payment assistance and then ask about buying it right now. Those don't go together. The rate
Can't do one or the other.
no, the rate is set by the state department, whoever, TSHAC or TDHCA, whoever's running it, it's set by them, and we don't get to mess with that interest rate. It changes every day. Right now it's in the 8s. It works best with FHA, VA. Conventional has a smaller portion on it. There is a bond program that TSHAC put out earlier this year. And I keep seeing videos that say, hey, this bond program has money in it again. When it has money in it again, it lasts about 20 seconds.
Somebody already.
Yeah. Somebody is sitting there stalking that website. I did it a couple months ago for a client of mine. I stalked that website like every 30 minutes for 2 days. And enough funds came available for my buyer to book it. We reserved it, we closed them, everything was great, but it's not feasible. That one went out so fast. And the interest rate on it is like 5.75. So when it comes up, somebody is stalking it. I promise. Okay. So the down payment assistance programs are income based. You can't make too much money and participate in. It depends on the county. So we'll look at that. They do require it to be owner occupied. Yep, owner occupied. Any questions about down payment assistance? They cannot currently own the property either.
Have to be like a first time.
No, they can't currently own property. So if they close on it today, if they close on their sale today and buy their purchase tomorrow, that's okay. Now, is a forgivable second lien on most of these? They're not grants right now. They're forgivable second liens. You can look it up. I look up TSHAC rates several times a day just to see if anything's changed. The offerings are going to be dependent on what they figure is available. It is forgiven after 3 years. So once they've had the mortgage for 3 years, the assistance is forgiven and they don't have to worry about it. But if they refinance or sell within those first 3 years, they have to pay that money back to the state. Any
Or
questions?
sell. If they're selling,
If
they
they
have to pay.
sell or refinance within the first 3 years, they have to pay the money back. Refinance is the big one because I keep hearing people say that rates are going to drop into the 2s again within 2 years. I personally, and I will go on record with this, I don't think we're going to drop below 4. I really think we're going to land in the 5s. But even then, if someone's got an 8% interest rate now and in 2 years it's at 5, they're going to want to refinance. Our job as lenders is to make sure that people don't refinance before that money is forgiven. Okay.
How much interest do they give for that, for like,
3, 4, or 5, at 2, 3, 4, or 5%, depends on which structure they choose.
And my mom bought a house in Puerto Rico. She bought it through the program for state gave them. And but the lien was not forgivable after 9 years. Right, so they had to live in the last 9 years in the house before they sell.
Texas used to be 7. For for many, many years, there's a recapture tax, it used to be 7 years. The worst time to sell it is in like year 4. But now it's just the second lien, forgivable after 3. I think it got too complicated the way they used to do it. Got too complicated. Somebody was telling me about a program in Colorado right now that's only for new construction, and the state will give them $20,000 for their down payment for new construction. And I understand the average house is like $600,000.
Yeah, and like, you don't know the taxes of that new house, so.
Yeah.
And you okay, I would just read that.
But it's just new construction. So again, when we come down to it, I'm going to tell you tips for a smooth mortgage process. Work with a local lender. I'm a huge believer in this. I'm licensed in other states. I don't chase business in other states. What I do is try and stay licensed in big military-based states so that when people leave Fort Hood, I can help them wherever they're going. Just like you guys do. You want to use that referral fee, don't you? So work with a local lender. Prepare your clients. I hate when people say, "Oh, the mortgage process is so easy. You're not going to have to do anything."
Oh, gosh.
That's not accurate. It's really not. There's work that has to be done by the buyer. Some buyers it's less work. Some buyers it's more work. The worse their credit is, the more work they're going to have to do. The more complicated their finances are, self-employment, investments, things like that, the more work they're going to have to do. But just prepare your clients. Hey, if one calls you, it's probably something they need, and go ahead and write it to them. They need to have accurate information. You know, your employment history. Thank you for putting that down on paper. I realize you've had 8 employers in the last 2 years. I actually need them to be accurate because then I'm going to go verify that. And that's what a lot of people miss is that not only do they have to give us the information, we also have to verify it. You can't just send me a W-2 for last year and I still have to have pay stubs that you're still there. So we're going to verify everything and we have to do it independently. So Yanni can't come to me and go, "Hey, I want a loan and I work over, for Jose. His cell phone number is this." No, I actually have to independently verify that I can reach him at a business. I can't just get a cell phone number. That's to help prevent fraud. So it's frustrating for people when maybe they work for a mom and pop shop who doesn't have a landline and all they have is a cell phone and it's not published anywhere. So those kinds of things are important for them to understand. Know the property requirements. This is especially important. Well, pretty much just everyone. Any property, if it has holes in the ceilings, holes in the walls, there's no doors, it's probably not going to go for mortgage. If it's got major structural foundational issues, it's probably not going to get a mortgage. Those are probably cash deals. This is going to be much more common with distressed sales in the next few years. We're going to start to see more foreclosures. And do you know why we're going to see more foreclosures? Interest rates, yes, but mainly because we can foreclose now. There's a moratorium on foreclosures for so long that we couldn't foreclose. So now suddenly we're coming out of that. There was a COVID moratorium on foreclosure. We could not foreclose on books.
Like we didn't evict from rentals, we didn't evict nobody out of offer. Yeah.
But everyone that was in foreclosure already told it that didn't make it up.
And we are back to pre-COVID levels of mispayments.
Yeah, but they're about to mass people again.
Well, let's hope not.
It's worse. They said
That's what
they're
they
not
say.
leaving.
They say that we're gonna see another blackout, like they're gonna close everything out again. That's what I'm saying, and I'm like, well, you know what?
They already closed this.
I think I already got my shots, too many shots of them.
They said this is-
Okay, bear with me for just a minute. We're on topic.
That's perfect.
So make sure the client is pre-approved, not just pre-qualified. If they do not feel inconvenienced by having some of their paperwork in yet, they are not pre-approved. They are just pre-qualified. This is a big difference. We are starting to see more lenders who are not pulling a full credit report. We are also starting to see, do y'all know what trigger leads are? Okay, when I pull credit on somebody, the credit bureau then sells their information to 80 of their nearest and dearest clients. That's the credit bureau. That's not me selling their information. That's the credit bureau. The credit bureau is selling the information to anybody that wants it. Hey, Samantha pulled their credit score is 680. Who wants it? And they start selling it to all these companies who put them in their call centers and they call all day long. One of my clients said he had 87 phone calls in the first 4 hours. And they're very, very aggressive. A lot of them will say, do what? Yeah, lenders all over the place. Call centers mainly. But they'll even say things like, somebody will go, oh, are you the Samantha? Oh, yes, we are. So we encourage people not to take those phone calls. I can disguise their phone number in my computer. Like sometimes I won't put a phone number and email address in because I think I'm being slick and I'm going to keep them from selling it. No, it's all public information already. The credit bureaus have it. They store. Credit bureaus are nothing but repositories of data. So they have all that data. They know where people work. They know where they live. They have their phone numbers and they have their email addresses because everybody who's signed into Credit Karma. They know your social. Yeah, don't they? So knowing the difference between pre-qualified and pre-approved is a big deal. You get these pre-qualification letters and they've got the little check boxes where you can choose whether or not you've seen their information. Y'all all seen these? If it doesn't say we have reviewed the information, that is a pre-qualification letter. It is not a pre-approval letter. I have another class that we do for like 30 minutes that talks about the difference between pre-qualified and pre-approved. It's important because you're protecting your sellers.
I'm seeing a lot of pre-qual conditions. What does that mean? Like pre-qualification and then it says,
everything's
subject to
conditional.
condition.
Subject to conditions just means like we don't have the appraisal or maybe we don't have all of our documentation. Conditional approval is really what you want. That means it's been through underwriting. It means the documents have been reviewed. Again, I have a class on this. Okay. So let's talk about this. The mortgage process can be complex, but with the right preparation, you can make it a little less stressful and a whole lot easier. Key takeaways from this whole class. Make sure the borrower understands. Make sure they're prepared and they understand that it's not just a simple conversation and you're done. I love my clients. I will trust my clients, but I'm still going to verify. And that's the key. Trust but verify. That's what lending is about. It's all about mitigating risk. And we want to make sure that we've got a loan that's going to perform. We also want to make sure that we're not putting someone in foreclosure. Because that's the absolute worst case scenario, right? Yeah. Nobody ever wins when somebody ends up in foreclosure.
I don't get no referrals after that.
That is so true. In conclusion, I'm Samantha Jackson. I'm with Guaranteed Rates. I have been a lender, like Yama said, for over 20 years. I just quit counting because it wasn't fun anymore. But I am also a certified mortgage advisor, which means that I understand how rates and all that other fun stuff do, and I understand guidelines. I read guidelines for fun because sometimes you can find things you don't know. I'm also a veteran mortgage advisor, which means that I've taken all the classes that make me better at doing VA loans. If you've got any questions about loans, feel free to let me know. I'm always here. I've always got my phone on me. It's rang like 14 times, probably a year turn. All those calls are showing. Thank you guys.
Thank you.
And I hope you enjoyed breakfast.
Thank you for breakfast. Thank you for breakfast.
We good?
Yes, I'm just putting her information in there. Take a picture, write it down.
Thank you. I'm still looking at that JDSA on demand. It's not coming out.
Nothing.